With no further delay, our moderator for our panel, and Aaron Betru. As I mentioned, he is one of our Board of Trustee members. He's also the Managing Director of the Center for Financial Markets with the Milken Institute. Please help me in welcoming Aaron and the panel.
Thank you, Wellington. So good afternoon, everyone. As Wellington said, my name is Aaron Betru. I'm the Managing Director for the Milken Institute Center for Financial Markets, but also proudly a board member of the foundation and a trustee that is very much a huge supporter of FHI 360 as well as FHI Ventures. We're excited to have this discussion because I think we want to kick off this point around the intersection of commercial investments and social impact in a meaningful way. And what we're hoping to do is push the discussion into a realm where we're talking about what does it mean to push impact investing into the future, and where are the new market opportunities for different investors. And so what I wanted to do is share a chart that we had profiled at a Milken Institute event with a whole bunch of private equity investors, impact investors that were still looking at each other, and philanthropic investors, and trying to say, what are you talking about? And so we tried to distill, essentially, when we were talking about the intersection of these worlds, it's a very hard thing for anyone to understand which thing is more impactful. Is it more impactful to invest in women and girls? Is it more impactful for an investor to think about it in the context of the environment? Is it more impactful to just say health? We all have our theories of where really the greatest impacts come for, but from an investor's perspective, when you start layering in the social impact lens, there's kind of a personal story when you make that decision that becomes rather hard to inject and force someone else to believe in. So we said, let's take a step back from that and let's actually just understand the how part of this. And can I get the first slide up? Essentially, the way to think about this in what we call our impact investing continuum, on the extreme right from what you guys are looking at, what we've been calling direct investments. This is the traditional way that everybody's been seeing this. Essentially, you find a specific project and you're providing a direct investment to this thing. It's essentially a tailored offering. I'm supporting a discrete element. It's very attributable. I know exactly what the social outcome of that is going to be, but it's also a lot of infrastructure that's required to get that to the end stage. This is where essentially the accelerator function becomes rather critical in converting a social idea into a commercial venture. This is what I would say was impact investing, 20, 30 years ago, and still is a big part of it today. I want to go to the extreme left-hand side of what you're looking at. This is where the trends that is happening in the space, largely driven by the millennial sector. Essentially, everybody's trying to find impact in their non-discretionary portfolios. When I'm buying a mutual fund or I'm investing in a fund, I'm sure most of you heard Larry Fink at BlackRock make a claim that he's looking for impact across the board. This is one of the largest asset management. It is the largest asset management firm in the world. And so the question in that scenario is they're trying to find things that is already scalable. They're not looking for, something that is a drone technology for in sub-Saharan Africa. It's essentially green economies, it's health. It's something that is rather big, but not as specific as some folks want. And this is where, essentially, call it your gateway drug for impact investing. This is the space that we're starting to see more and more happen. And then there's things in the middle. Essentially, how are you going to find investors that do have a thing that they want to support, but don't have the infrastructure around them to find discrete things? Are there platform plays, middlemen, if you will? And there's a wide swath there. There's a UBS created something called a Line 17. So this is a platform play for ultra high net worth individuals to find specific deals, and it's just a technology platform. Essentially, it's crowdfunding for impact investing. And there's a bunch of those that are out there. In fact, the US government has now entered into this foray. The BUILD Act, that was providing equity authority within OPIC to be able to actually be a conduit to bring institutional markets to find impact investable deals in the developing world. There's other reasons why they also are doing that, but essentially it's a platform play in the middle. Some way, all the various different players, they're somewhere on this continuum, some variations of it, there's permutations and whatnot. But at the end of the day, we're trying to find the intersection of more commercial capital with traditional IRR calculations, to what Wellington said, to things that are scalable but also socially impactful. Fortunately, I can say we're lucky to have a bunch of pioneers on the stage that are going to simplify everything and actually provide a perspective of where they're seeing impact investing today, but where it's going into the future. And so with that, I'd like to just take a second and allow each of you to, I'm not going to even pretend to know all the accolades that you have, so I'm going to say take a good 60 seconds and provide a little bit of context of name, organization, and its involvement in the impact investing space, and then we'll come back to a little bit of the Q&A. Why don't we start on the opposite end and then come back?
Joan Seifert Rose. I'm with a group called Launch Bio, which is a nonprofit partner of a group of co-working spaces called Biolabs. I am probably the least impact investing traditionalist in this room. And partly what I want to talk about today as we get into it is how perhaps a more conventional venture, private equity-backed idea is now starting to converge with impact investing. So right now I'm based here in North Carolina. I work with a co-working space that has 30 life science startups about a half a mile away from here. It is part of a network that is home to 300 life science startups, all of which potentially could be of interest to impact investors.
Fantastic. Hi, everybody. I'm Kathy Clark. I am faculty director for CASE, the Center for the Advancement of Social Entrepreneurship, and our CASE I3 Impact Investing Initiative, 10 minutes away at Duke University's Fuqua School of Business. I have been an impact investor for a little more than 25 years. And have been trying to basically build the field and marketplace of impact investing during that time. At CASE, we are a research and education center that trains the new generation, does research, and works to improve practice. And so we're delighted to be here today.
Hello, is this working? Can you hear me?
Yes.
Oh. So I'm Catherine Burnett, and I am the Chief Impact Officer of Phillips Enterprises, which is a family impact platform. That's a little unusual. It's probably one of the first such organizations that is led by millennials. The Phillips family is currently under millennial leadership. The two principals are in their 30s, and they inherited their responsibility for the family's wealth when they were 24 and 25. So they are really the tip of, or the beginning ripples of a tidal wave of wealth transfer that is happening in this country. And I think what's interesting for people is to look at them as a case study for what the future is going to look like. This young couple, they said, we did not make this money. This was grandfather's, but we are stewards of it. And we are responsible for having 100% of these assets drive positive change. So we can talk more about context in a little bit, but just that's a little bit of the big picture.
Thank you for that. I think, Kathy, I'm going to start with you. 25 years, okay. So when you're looking about your experience, essentially, there's something to the effect that efficient markets are when you have good supply of investable deals as well as good demand for that. In looking in the past, what did we get right and what didn't we get wrong? What didn't we get right in terms of the impact investing space, and what are the takeaways of that 25 years?
In a few minutes? Okay.
I'll give you 5.
You give me 5. All right. That's a tough one. I think there's some things that we're definitely getting right. When you look across, I have a kind of, I loved your chart. I have a value chain kind of picture in my mind when I think about the impact investing space. And so actually just came back from SOCAP, where Fran Siegel and we do an annual, this is our 5th, so not 25, but 5, kind of state of the field. And we divide the field into the supply side and the demand side, and we talk about the trends in each. And on the supply side, we have just a tremendous amount of activity and traction, right? So if you divide the impact investing marketplace into kind of the publicly owned side and the private investment side, we have some incredible numbers going on. So the GIN estimates that annual increases in impact investing in the private markets have almost doubled every year for the past 5 years. It's now over 114 billion. Which is nothing to sneeze at. The public side of the market is perhaps even more impressive. The US SIF studies the amount of money that is invested in the US stock market that is screened for some sort of socially responsible purpose. When I started paying attention to those studies about 10 years ago, it was 1 out of every $7 in the US. As of last week, it is 1 out of every 4. So a quarter of the professionally managed assets in the U.S. are now screened for some sort of social responsibility, which is not necessarily the same as full impact, but as you said, it's the gateway drug. And so you gave context to that, which I love. So on the supply side, we just have an incredible amount of people saying, I want to put money into this, and I'm going to ask the professionals who manage my money to do this. The question is, where are we putting that money? And are we putting it into impact in ways that are sustainable and scalable and are actually addressing the problems that we have? And on that, I would say we're doing less well. There's a lot of us, including most of the people in this room, who care a tremendous amount about this. So I know we can do better. But when you look at the ease at which enterprises who have some sort of, are either working in an impact area that we recognize, like health or education or financial inclusion, or are articulating real goals around those areas. There's a recent study that just came out of the Aspen Network of Development Entrepreneurs saying that they are actually having a harder time getting money. So we have this very strange thing where we have more and more supply, and we have a harder climate, perhaps, for some of the entrepreneurs. And from the, you mentioned millennials, and universities, we have so many new ideas, right, coming out. But there's a gap, and that pioneer gap in the middle that Wellington talked about is very real, which is we have a lot of capital going into the shiny new thing. And it's usually grant capital, and you can give them a prize, and you can give them, you can feature them in your school paper, and that's all very fun and well. But then when you actually try to say what's investable, right, there's a gap there. And what we believe is there's kind of 2 reasons that this gap exists that we can work on. One is the conditions that the capital is actually looking for are quite constrained. It is not all the same capital, right? Capital comes with what kind of vehicle, what geography, what is the person who's put it into that vehicle promised their investors, right? So there's usually 5 or 6 kind of what we kind of call knockout criteria for any impact capital that needs to find its way into the marketplace. And for any particular entrepreneur, there may be only a handful, even though the supply is bigger. Right, so that matching thing. The second thing that we found, so in addition to my academic hat, we ran an accelerator for 5 years here in Durham, but we worked with entrepreneurs around the world. And what we found was those entrepreneurs, they were very sophisticated, but they didn't always understand what the conditions were of the capital that they were getting and how it would either propel them or hold them back from doing their dual objectives, which is growth and impact. And so we became really concerned about this, and it was one of the impetuses for us to create the Case Smart Impact Capital platform, which we've now entered into a partnership with FHI Ventures, and so we're really happy about that, to realize that this is a much more complex world for the entrepreneur than most investors appreciate. So when we went out, just like 1 more minute, when we went out to build this toolkit and said, well, what do entrepreneurs have to understand to raise capital well and get a deal that actually works for them? We said, well, how many different vehicles are there? And you named 2, Wellington, right? Equity and convertible. We actually have 13 in our series because there's 13 different vehicles that people are using and they all have different constraints. Most investors don't even, I've been an investor for a long time. I didn't know about all of them. And so there's a load on these entrepreneurs to figure out how to do this right. And that's what needs to happen. Both parties need to understand what's the right tool for the job to get it done.
This point on kind of the dual goal of essentially growth but also impact, how difficult is it in your mind to actually make sure that the entrepreneurs that are coming across your threshold are actually focusing on both? From an investor's perspective, clearly, I'm interested in both, but definitely growth matters.
Growth certainly matters. I think, again, I was a foundation investor and then became an angel investor and then ran a small fund for a while. So I've done it from different perspectives and have been teaching social enterprise for over 25 years, this is the issue, which is at the enterprise level, what are you doing? What are you doing differently? How are you making changes around what you might be learning about your impact or your growth? And what do you do when there are friction points between them, right? What do you have to manage differently as a result of that? I think the answer is you can, but you have to be aware of what it is that you're committing to do, and you have to understand what is the pattern of growth that you want to be on and that your stakeholders agree that you're on. And that's where it came down for me. This is overly simplistic, but for me it came down to there's kind of equity level growth, and then there's everything else. And the constraints of venture capital and equity level growth, and I know we have some equity funds in the audience today, it's a very specific kind of growth pattern that kind of fund must choose to invest in. And many of the ventures, especially in developing markets, who are either trying to figure out what a customer needs or then starting to scale what a customer needs when maybe that customer is a low-income customer or there are other issues in distribution, you may not be a high-growth venture. And so to me, one of the most important things is recognizing that and helping both the entrepreneur and the funder understand what they're committing to.
Joan, I'm going to ask you to react to that because what I heard is essentially readiness matters. Essentially, these different ventures being ready for the next stage of capital, both under whatever the 5 metrics that are the knockout elements. You at Launch Bio are right in the center of that in terms of helping these entrepreneurs that you've dealt with, but with a much more commercial lens. And now that you're crossing into this realm, so
it's really interesting listening to this conversation because in many ways I think those of us in the healthcare sector and actually drug discovery have found their way into the social impact space almost by accident. And the reason for that is that, so I'll give you background. So as I mentioned, Launch Bio is a nonprofit partner to a network of co-working spaces. In those co-working spaces, up to 300 companies that are working on drug discovery and therapeutics. The initial idea behind this was improved capital efficiency. So that appeals to investors. So the idea is that companies can come in and grow much more quickly. They don't have to rent a lot of space. They don't have to buy a lot of equipment. They can work on their science. Well, the initial folks that were attracted to this model were your traditional private equity investors. And then there were some pharma partners that were interested. And now we're finding that this is also a very capital efficient model for foundations that are interested in curing or finding new treatments for particular diseases. So last week, Wellington was one of the speakers on our panel. We have some partners in the room that helped us with this. We had 9 nonprofit disease foundations come to Durham to talk about how they're doing deals and how they're finding these companies. And what we've realized is that the criteria that they are using to look for ways to partner and accelerate the pace of commercialization or the pace of creating new products that can benefit their patients, well, that looks a lot like a traditional investor model. But the outcomes they're looking for are different. So interestingly enough, one of the biggest questions that we got when these foundations were coming into town to meet our companies and to meet our network is about syndication. So how do you do a deal where you are marrying impact, where you're looking essentially to have a better outcome for a patient that might be improved through investing in a company? And we are talking about investments in companies. Most of these foundations have been giving grants for many years, but now they are moving into the impact investing space. They are putting in equity, they are doing risk investment. They are co-investing with others, and that is a new step for many of them within the last few years. So their real question is, how do we play in this world? Yes, we really like the capital efficiency that this model is providing us, but how do we work with a pharma or a venture fund that also wants to put some money in? And how do we possibly come up with outcomes that everybody can feel we are, getting something out of and that align with the values? At the end of the day, I think that these, from what we saw, these nonprofit foundations are really interested in playing in this space, but they just don't quite know yet what that looks like. And I think they're looking for help from all of us to figure out how to make that work. I'm excited, though, to see this. I've always been interested in impact investing, and to see that we're now moving into this space in sort of a more traditional healthcare, health discovery field, to me feels like a really interesting development. And I also want to give a shout out to the Milken Foundation for having done Faster Cures, where many of these foundations have been talking to each other for years, and many of them came up with this idea of starting impact investing funds because of the conversations you helped lead.
I'll say you're welcome. Clearly, there are thousands of folks or hundreds of folks in our headquarters that are way more responsible for that, but thank you for that shout out. Where's the special sauce in your mind between that shared service model with regards to the ventures, or the shared services model for the foundations, the investors? Where do you think is the special sauce?
Oh, I don't know. I think that everybody's trying to figure it out. I suspect that there will be, various experiments. I have talked to a number of the foundations who, for example, said they got 90% down of the way on a deal with a venture fund, and at the last minute, things just didn't work out. Sometimes they want to make an equity investment, but they need to do debt financing instead. I don't know. I mean, I think that we are still waiting for that great example of a collaboration to see how these two worlds marry. We occasionally have some examples of foundations that have gone it alone, or gone in with other foundations, or gone on in with a grant program and then had a great exit, but we just haven't seen that much happening in this world yet. But I know there's a real active interest in it, and I suspect that we will start seeing some new vehicles emerge, maybe some new ways of creating an entity where both groups can invest into to make an investment into these companies. And I just think we're into a new world and a new source of capital that's coming into these enterprises. And I will also say, as you talk about too, younger scientists that are working in this field are eager to work to see a real difference from the research that they're doing. And so I think they welcome these discussions as well, and knowing that they're going to make a difference in the life of patients.
Thank you for that. I mean, it's rather interesting that you articulated this point around essentially creating better linkages in a quote-unquote supply chain or value chain. And Catherine, I'd love for you to react to this, because you host a very interesting dual role, both in terms of being the head of impact investing for a for-profit entity that's attached to a foundation where you're the head of the foundation as well. So in trying to think about that dual responsibility and creating linkages within Philips Enterprise, I'd love to hear your thoughts on how a corporation is doing it.
Sure, thank you. And I guess I should give a little more information about that. Philips Enterprises is the impact platform, as I mentioned, of the Philips family, and that encompasses a number of operating businesses, mostly real estate and a family office, and then various philanthropic entities, including the family's collaborative philanthropic entity, Philips Foundation. And so we really do look at I have several different business cards and think about which hat am I wearing right now, and sometimes need to switch halfway, and sometimes we can find opportunities for collaboration between the entities. But I think when we, there are a couple of different ways I can approach this question. I think I'll start with the foundation's perspective. The foundation, when we move to 100% impact invested assets, that gave us a lot of information that has helped inform our strategy for the investing the family's liquid assets through the family office, and also thinking about strategy through the company. At one point, we had a grant. We actually no longer make grants. We only make PRIs now for the purpose of catalyzing more capital and amplifying our impact to a larger degree. But back when we did have grants, we were working on a grant to end chronic homelessness in Guilford County. And a really key component to that was to have places to rapidly rehouse chronically homeless people, to provide wraparound support services to help them get back on track and become more stabilized and become contributors to society. And so as I was walking by the whiteboard outside of the largest operating company, and I happened to notice a vacancy rate on some of the properties that I thought would be really well positioned for us to house formerly chronically homeless people. So that was actually a really neat way to leverage, to have the family company provide at market rate, provide the housing that was then covered by grant funding from HUD, and then the foundation's support brought a collective impact model to Guilford County, where all 80 homeless serving organizations were tapped into a data system where they could share information and use their resources more efficiently and effectively. And then we, together with the family company and with the foundation, started moving forward to put together a social impact bond to scale this model statewide. And so I think there's some, and ultimately, we were able to decrease chronic homelessness in Guilford County over 3 years to 3 individuals. So I think there's a lot of power in using for-profit and nonprofit to collaborate together and think about impact. We really think about impact. We consider grants impact investments. They happen to have a negative 100% financial return, so they're maybe not the most lucrative, but we really look at the entire continuum, and I think that's one of the benefits of working for a family with these various different assets. We are able to come up with creative collaborations that can really move the needle on issues.
You raise a couple of things in your answer. Essentially, one, it's not an easy thing to find that intersection of financial returns and social impact. You have to look at your full suite of different issues. You talked about the HUD grant that you were dealing with. Essentially, when public policy actually works in your favor, it's something that's important for folks to consider. I want to change gears for a second and actually ask the folks to react to something that's a new development in terms of how potentially impact investments would go in the U.S. How many of you have heard of opportunity zones? Wow, okay, that's more than I was expecting. Well, for the rest of you, you're sitting in one. So we are in a piece of land that has been designated, quote unquote, as an opportunity zone. This stems from a recent development in the tax laws that were passed in this past December. Essentially, out of the 1,000 pages, there was 5 pages that did 2 things. First, they introduced the right for each of the governors of the 50 states, plus all the territories in the district, to select up to 25% of their low-income census tracts. If I could get the next slide, actually, just as an overview. What it did is it created these zones. They are low-income census tracts throughout the nation, roughly 8,700 of them, and it was 100% opt-in for the entire nation, including roughly 97% of the island of Puerto Rico. That's one thing it did. The second thing that it did is it actually created a series of efforts that would lead to a tax benefit, all based off of capital gains. Essentially, if you are someone that is sitting on unrealized capital gains, whether it's real estate or stock, and let's say you sell it today, you would be given 6 months to put it into something called a qualified opportunity fund. What this does is, as long as it is investing 90% of its assets into an opportunity zone, you as the taxpayer get automatic deferment of whatever you sold today to 2026. You get a reduction in the taxes that is based off of how long you're stayed invested in the fund, roughly reductions of taxes of 10 and 15%. And then the third benefit is if you stay in the fund for 10 years, any new gain in the fund is 100% tax-free. In terms of the new capital gain is tax-free. So for all the investors in the room, let's just say you can take a 9% IRR business and then turn it into a 15% after-tax IRR. So this has become a very powerful tool that a lot of people in the U.S. are starting to lean in and figure out if they make investments in opportunity zones, what would they do? And essentially, majority of the interest in this has been in the real estate space. And so this is something I'd love to hear your reactions in terms of, as a real estate operating company that Phillips is, how are you guys thinking about taking advantage of opportunity zones, and a lesson to be heard by some of the entrepreneurs here in terms of being companies located in opportunity zones?
Thanks so much. That's a great question. And actually, we're looking at the opportunity zones as an opportunity from all three of our units. So from the real estate company, looking at the company develops and manages multifamily housing and are expanded into some other areas as well, industrial and commercial real estate and single family homes and townhomes. But for us, we're looking at some of our properties are in opportunity zones and they need to be repurposed. But then that brings up the ethical dilemma of, well, if we reposition them, are we then gentrifying the area and pushing out the very people who opportunity zones are supposed to be helping? So we're carefully examining opportunities, and but bringing the impact lens again, as the family are stewards of this wealth and want every dollar to make a positive difference. We can't make people homeless. It's certainly not in alignment with our work. And then from the family's family office, we are looking at capital gains, tax benefits. And then from the foundation, we're actually looking at guaranteeing opportunity funds. That would make them more attractive to investors, particularly in areas that might have a harder time attracting investors, maybe some of the rural areas, some of the smaller cities. If we can provide guarantees, then investors will be more likely to invest in those areas, knowing that if something goes wrong, we would ultimately bail them out.
Just for a little bit of clarification, so from an investor's perspective, they have to just make an investment in what is a qualified opportunity zone property. So that property can be actually a business or can be real estate. It's just, think about the context of, somebody that's sitting in a very wealthy neighborhood, billions of dollars of gains, realizing the opportunity in something that's in a low-income neighborhood across the country. It's just easier to look at real estate. However, there is a big push to actually spotlight ventures that are located in zones. And so, Kathy and Joan, I'd love to hear your thoughts on what do we need to do to make sure that this goes to job-creating ventures rather than gentrifying neighborhoods.
I think this is a really interesting opportunity for the people who care about impact, because what opportunity zones have done is enlarge the conversation to anyone who can benefit from a capital gains deferment, right? So it's a much more heterogeneous group than people who think about impact for a living. And if you talk to, I have some friends at law firms, and they're saying, suddenly half their business now is giving people advice about this. And what it makes me think of, when you were saying, well, it could be a business, it can be real estate, what it makes me think of is some of the conversations that we went through in the early days when we were developing the standards for B corporations, which was, what part of this business actually has the potential to have impact? And how do we articulate that? And how do we compare businesses, in terms of what they're doing? And I think the opportunity zone conversation is a little bit of the same conversation, which is, if you are a real estate development inside this zone, what are you doing that's impactful, that an impact investor would want to support, or bless as you're getting your tax credit, right? And the same thing's true at a business level. Is it jobs? Is it something else that they're doing inside that community? Are they using all the supply chain locally? You could imagine, again, the laundry list of the 256 things that we asked B corporations to answer. I think it's a great opportunity. I don't know if other people are thinking about it that way. What I do see in the marketplace is other impact investors, especially foundations, saying we have the opportunity to raise the bar a little bit and to as you were saying, Catherine, and to show some good options. Right? So if you do care about impact and you also want to get this credit, here are some better places, right, to put your money that you can be assured, because not everyone is going to be able to do all the diligencing and vetting to make sure that over the long term, this investment is not actually harming this community.
Thank you. I think you raise a good point. Essentially, there is something like $6 trillion of unrealized gains in this country, and as people are starting to look, it's going to behoove the rest of us to provide the actual investable opportunities, and then you'll find a very new group of individuals that maybe they came to the table just for their capital gains, but they'll stay for the impact. And with that, I actually wanted to bring the audience into this conversation. You've got some pioneers on the stage. Love to get a little Q&A going for the last 10 minutes of this conversation. So if there are any questions, we've got folks walking around with microphone. Please raise your hands and share. I've got a question. So we're looking at how hard it is to go beyond that non-dilutive capital to more commercial capital. When you're looking at essentially the entrepreneurs that are either part of the FHI Ventures program or new ones that are thinking of coming in here, if they had a choice to be made by essentially thinking in advance about the venture that they're doing versus the financial engineering around their venture and bringing different types of capital to the table, what would you recommend that they focus on?
Can you repeat the last two sentences?
Between financial engineering to get the returns for investors versus getting the business concept clean and simple. What's more
I think
important?
it depends on the stage that the entrepreneur is in. I don't think any entrepreneur can start by saying, I'm going to be a 12% return business. They're going to fail. They need to start by saying, do I have a customer and do I have a product or service that that customer is going to be delighted with enough to pay what it costs me plus something, right? And that's the early work. That's the blueprint work of trying to figure out whether you can get that engine to happen. Then I think you end up learning things that tell you over time, and sometimes it's quick and sometimes it takes a long time, you know, what's the scale of the growth that you can do in that business. And then other financial options occur to you, you really want to jump in. So I'm going to let you.
I do. So I would just say to the entrepreneurs, like, there are so many different kinds of capital. So do not trade off your impact. That is the most important. And there are funders like us who will pay concessionary rates and will be willing to concede upside in order to help make sure that your venture can make a difference in the world. And we will, obviously those will be PRIs, they'll be out of our 5%, but do not trade off impact for it in thinking about how you're going to make this work financially, because there are funders who can show up at the table with a lot more flexibility.
And I'll just say also for early stage, you know, many of the companies that we deal with are pre-revenue forever. And so one of the true. And one of the things that really is true is, you know, how well you manage the money that you have. So I think there's a lot about really understanding that the money that you've been given is to accelerate your growth and to use that wisely, and that is going to be the thing that investors will look at to help get you to that next round. To ultimately, you will find a partner, a buyer, you know, you'll find some exit, but because scientific investigation is such a long process before you really see some returns, if at all, managing capital efficiently has really got to be at the top of the list. And you can't imagine what your outcome is going to be. I mean, I would not even begin to say, oh, we're going to, you see the hockey stick, right, projections, right, you know, well, 15 years out, we should be making 30 times, no, sorry, that's not going to work. So just focus on the business, focus on the science.
Great. I think we have a question back there.
Yeah, I'd like to ask a question about management teams. I come from the venture capital world and like, and a VC will very quickly fire the founding team if they've picked the wrong horse. And I guess the question is, in the impact investing world, are you guys going to do that, or to ensure the success of the venture? And how do you deal with that part of the gap between the two worlds?
The impact investing world is at least 11 different kinds of investors, and I would say private equity is one. And so the answer is yes and no. There are investors who will decide that the horse is not the right one for the commitment that they've made, and there are investors who will support and nurture. And there are investors who will do both at different times. So it's just too generic a question for an extremely diverse set of actors, if that's okay.
And I think, again, just and then I see there's another question back there. Thinking about what is the source of the capital. So for us, if it's a market rate investment, there's a little less flexibility than if it's a program-related investment where it's concessionary. But we do tend, and maybe it's just with the impact lens, we tend to invest in people and who have great ideas and who have a track record of being able to deliver results. And so and it may just be the family's lens, but we don't trade horses. We invest in people.
I really like your answer, Catherine, better than mine, because what you showed was it actually depends where the capital comes from and what the constraints are. And so if you've raised a fund for a certain amount of return, which is what venture capitalists do, you are forced to try to get that return to happen, right? But if you're a foundation investor, if you're in an individual, so we know individuals who have multiple pockets, right? And they can kind of do whatever they want with the pocket they have, and they can switch pockets halfway through if they decide to.
Yep. Yeah. I think there was a question right here, and then we'll go to the back. Yeah. Please tell us your name and where you're from. Yeah.
It's not working.
It's-
You just press the button again, see if it turns green.
Actually, kind of a blending of the last several questions, but from the investor perspective, I'm curious, it seems like a dilemma of serving two masters, so both the social impact and the financial return. And I'm wondering if the smart and successful investors who try to find that balance do so at multiple points along their engagement with the portfolio company or defining that portfolio of companies, or if they stage that. For example, is the social impact element a criteria for initial selection of investments, but at that point then it becomes drive hard towards financial returns with the assumption, the premise that when those companies are successful, they will have a positive feedback into social impact. And therefore, there's sort of a staging instead of always a simultaneous trying to strike that balance between the two. Does that make sense? Yeah. Does anybody?
Yeah, sure. So, you go ahead. Okay. So I think for us, it's simultaneous. We won't consider an investment unless there is that really strong social impact. But then again, depending on what pocket we're investing from, we have different criteria for what is required financially. But for us, and it probably differs individual to individual, but for us, we won't consider something unless there's the social, but then the financial is right up there with it.
That was exactly my point. Essentially, you'll find a lot of investors that have that more or less industry screen that is a social impact component, but by all means, this is not meant to be a subsidy at forever. It is meant to find some sort of financial return. They might trade off a little bit in terms of maybe I'm not looking for something that is triple-digit returns. I'm willing to take something a little bit less for the social impact, but it is not at all meant to be a subsidized play forever. There are different pockets of money that go into that, but in this unique space, it's making sure folks realize that you have to do both.
And I just want to add too, and Rob, I think you know this just from the Biotech Center work, that in the health research space, especially through the disease foundations, many of the contributors are high net worth individuals who in the past have been approached to make investments directly in companies. In many ways now they are looking to the mechanisms that the the foundations are setting up to do that screening process for them. So increasingly now you will see, as I say, as foundations start to make more direct investments in companies, they are hiring people with venture experience from the VC world. They're putting together teams that look very much like traditional due diligence teams, and they look at the sorts of, like I said, the outcomes they're looking to arrive at are somewhat different. But I think that this is one of the trends that I'm seeing, where in the past you might have gone to a particular wealthy family and say, would you make an investment into my company? That's now becoming more professionalized, and I think you're seeing that the foundation stepping into this role, and then presumably also that they will be expected to have both returns so they can make additional investments, but also achieve the outcomes of better results for patients.
I think there's a question in the back there.
Yes, thank you. Heather Shawnee with the FHI Foundation, and it's kind of a nice segue into the last question, because I wanted perhaps the panelists can talk a little bit about blending these different tools, because Kathy Clark, you mentioned that there's 13 tools available, so it isn't just an equity or debt play, but there's actually different layers that can come in. And I think particularly with institutions like, Catherine, the Phillips family, and even our own FHI Foundation, FHI Ventures, this wonderful global organization that is the deliverer of social impact. How do you maybe mesh these different tools together to create that ecosystem and kind of de-risk those other more traditional investments?
So I'm going to say, since the panel time is almost over, why don't you weave in that answer with your final comments, and we can allow, perhaps start from this end and go down.
Sure. So thinking about blending capital in order to reach our impact goals, in some cases we do look to de-risk. When I was mentioning the guarantees for opportunity zones, we think that's a really important aspect of our work. There's one example that might be helpful for people when we think about, we work with an organization called MCE Social Capital, and they are essentially a merchant bank, and they get commercial funding to then fund MFIs and DFIs around the world. But what they do is get guarantees from donors. So they have about 1.5 times all of the assets that they have that have been deployed to social entrepreneurs. They have about 1.5 times in promised guarantees. And that actually allows the banks, the commercial sources of funding from which they're getting the funds that they need to do their work, to A, come on board at all, and B, provide funds at a much lower rate. So I think I don't know if that's helpful, Heather, but, and then for my final comment is really just this space is growing so quickly and so beautifully, and it's amazing to see all of these people in this room who are bringing value to this ecosystem building. And I think it is just on the up and up, and really such a pleasure to be here. Thanks.
So we did a study 4 years ago of high-performing impact investment funds, and we didn't look at all of them, but we looked at a subset, and then we narrowed that to diversify. And then we looked at what some of the common characteristics were across them. And this idea of layering different kinds of capital together, we called it catalytic capital. And we found that about 1/3 of the high-performing funds in the marketplace as of 4 years ago had that as part of their structure. Our definition of high-performing, by the way, was not just on financial return. It was met or exceeded investor expectations on both financial return and impact return, impact expectations. And what was interesting to us is we ended up creating almost kind of a development model where we realized that there were some funds who always wanted to have some de-risking capital as part of what they do, because they were trying to address extremely hard to reach populations with entrenched problems. And then we saw that there were other funds that actually used, often it was either nonprofit or foundation money or government money, to be the catalytical layer, either a loss guarantee or a lower subordinate layer, to allow a bank or another non-dilutive player to come in with confidence. And with several of those funds, they were able to do a second fund or a third fund without the layering. So it was actually a process of de-risking a market where everyone's like, you can't make money on that. And they're like, let us show you. And then once they did, you don't need that stuff anymore. And that's a wonderful, we thought that was a wonderful way of seeing the progress through the marketplace, and how you can actually move from funds that are blended rate funds into completely market rate funds. And it's basically a perception gap, right? That you're countering. You're not doing anything differently. So if you're interested in more of that, I can refer to that. The final comment I would make is we've become really interested in the last 6 months or so in some of the attention that's being paid around the world by multiple institutions to gender lens investing, which is another area where this blended finance is really becoming very important. And I just wanted to mention that we are doing a program in March, a 2-day program here in Durham on gender lens investing, and we'd love to have any of you be part of that as we study what's being done and help people to become, kind of in 2 quick days, how do you get the basics under your belt so that you can actually put the money to work.
And just for me, I'd say that new conversations are happening in this space all the time where I sit. In addition to millennial investing, really expecting more from the type of commitments they're making to advanced technology. We're seeing a whole group of successful tech entrepreneurs entering medical research space as well, and these are folks who have the ability to come in and write a check very quickly and expect things to move much faster than things normally do in the medical research space. So I would just say worlds are colliding, and that's what I think the future looks like, and I think that there's lots of opportunity and many things that probably we'll sit here a year or two from now, we'll be talking about new types of investment vehicles and new partners that are coming together to make impact.
Yeah, thank you for that. Now, I'll take your thread in terms of the worlds colliding and take moderator's prerogative in adding to this blended finance point. So essentially the guarantee space is something that the Milken Institute has looked very deeply into. And actually, when we talk about structuring and blending different types of capital, even within guarantees, there are good guarantees and bad guarantees. What we ended up doing with my co-author, who's sitting over there, raise your hand so you get some credit too. There he is. Essentially looked at 80% of the guarantee market that's done by bilaterals and multilaterals, and found that the way that folks write these guarantees, they don't actually work for most financial entities. They're filled with conditional elements. They are not tradable in 30 days. Essentially, they don't provide the same balance sheet relief. And so in terms of colliding both policy and innovative financing, there's, I would say, impact investing that we are experiencing today is nothing like what it was 20 years from now. And the worlds are definitely colliding, and I would say in the next 10 years, it'll be very different than what we are experiencing. And with my final comment, I'll ask, who are the investors in the room that are looking to make an investment probably in the next 6 to 12 months? Can I get a show of hands? Who are the investors out there? All right, so all the entrepreneurs, that's where the money is. And with that, can I get a thank you for panelists and hands?